Hello, and thank you so much for clicking and watching this video. So you want to know how to buy a home. You want to know the steps involved. You probably have many people trying to give you advice. You've probably been invited to multiple home buying seminars. You don't know where to turn. So where do you ultimately turn to? YouTube. But guess what? You're a genius, because I'm going to tell you everything you need to know about how to buy a home in just 7 easy steps. And hang on to the end, because I'm going to share a pro tip with you from somebody who's been in the business for 20 plus years about how to buy a home in this incredibly tough seller's market. That's right. Right now, this is October of 2023, is a seller's market in most parts of the country. What that means is there is way more buyer demand than there are homes for sale. Therefore, decreasing buyers' chances of getting offers accepted because there are so many buyers. So I'm going to share with you a pro tip about how to get your offer accepted over other offers. All right? If you like what you hear, please give me a like, give me a thumbs up, and subscribe. I really, really appreciate that. All right, so without further ado, we're going to get into the 7 steps. I'm going to share these 7 steps with you, and I'm going to talk to you almost in an outline version so it's easy for you to follow along. I'm going to tell you what happens at each step and what you can expect to spend for money at each step as well. People forget that. There are some expenses as you go throughout the process. Okay, so without further ado, we're going to go to step number 1. Step number 1 in the home buying process should always be to get pre-approved. Now, I know you want to go out and look for properties first because that's fun. Going through the mortgage process may not be as fun as going home shopping, but it should be the first step, okay? So the first thing you're going to do is get a pre-approval. People always ask me, who do you recommend I get a pre-approval from? Well, obviously, I would love to work with you, but I always recommend you speak to someone that has had a positive experience buying a home and using their mortgage person. All right, if somebody had a positive experience with their lender, that's probably a great place to start. Okay, so a pre-approval should not cost you anything, but some lenders are gonna wanna charge you an application fee to do a pre-approval. Why is this? Well, the thought process is if you pay money to get a pre-approval or pay for an application, you are less likely to go to another lender when you eventually get an offer accepted and need financing. Okay, so that's tip number 1 here. You do not need to utilize or use the person that did your pre-approval for the financing. Let me say this another way. You can get a pre-approval from one lender, but then actually get your financing from another lender. Therefore, you don't need to get multiple pre-approvals. I actually recommend getting one pre-approval, and then ultimately when you get your offer accepted on a home, that's when you want to shop around and try different mortgage people, okay, for financing. That's when you want to get your quotes. Okay, so the first step in the process is to get a pre-approval. I'm going to break down what's involved in a pre-approval on a different video, so stay tuned for that one. But we're going to move on to step number 2. Step number 2 in the home buying process is to make an offer, okay? Now, I'm in Massachusetts. We go offer, inspection, purchase, and sales. Some states just have the offer. This is your contract, okay? So either way, when you make an offer on a property, depending on where you're buying, you're gonna need to write a deposit check, okay? Also called earnest money. And depending on where you're looking to buy in the country, that number can vary. Here in Massachusetts, a $1,000 deposit check is pretty customary, it's pretty normal, okay? So what happens to that money? Well, that money actually gets held in an escrow account or an intermediary account. It will be delivered to the seller at closing should and when you get to the closing table, okay? So you write your $1,000 deposit check. Well, there are basically 2 scenarios when you make an offer. It either doesn't get accepted or it does. If your offer does not get accepted, that $1,000 is going to come back to you. If your offer does get accepted, that's when it would get put in the escrow account and be delivered to the sellers at closing. For the sake of this video, let's assume for a second that your offer does get accepted. Okay, and before I move on to the next step, Remember too, that there could be a lot of time between steps number 1 and 2, right? It may take you a year to find the right house. It may take you a month. You may look at 100 houses, you may look at 1, right? But the reality is that between steps 1 and 2, it all depends on how many houses you're gonna look at and which house is the right fit for you. Once you find your house, you get your offer accepted, you write your deposit check, we move on to step number 3, which is home inspection. First of all, the important thing to note here is a home inspection is not required by anyone. The lender doesn't require it, the seller is not gonna require it. It is not required, but it is definitely recommended, okay? You're gonna find in tricky sellers markets like the one that we're in, you may find some other buyers may actually waive their home inspection, okay? They're doing this to make them seem like stronger buyers to the seller. Think about it. If you are a buyer and you're making an offer for $500,000 and another buyer is making an offer for $500,000 and you have a home inspection contingency and they don't, the money's the same, which one is the seller probably gonna take? The one without the home inspection, right? And the reason for that is because there's less involved. There's less chance of that person backing out if they don't have the opportunity to inspect the home. Again, I don't recommend that you waive your home inspection contingency. I definitely recommend you get one, but I understand you do what you have to do in these tricky sellers markets. So first thing, you're gonna get a home inspection. Second is it will cost you some money here. Okay, depending on where you are in the country, how big the home is, what type of home it is, if it's a multi-family home versus a single family, that will be more expensive. But you could expect to probably spend over $500 for a home inspection. Okay, now that is money that you will not get back. So even if you don't move forward with this purchase, you won't get that money back. And the reason is because you're paying a licensed professional for their time. Now, what should you expect after a home inspection? Well, probably at a home inspection, you're gonna have a good idea about that property at the inspection. If you're walking around with your inspector, okay, he or she is making sure that that home is gonna keep you warm, safe, and dry. Okay, those are the big ticket items. The inspector is gonna tell you everything you wanna know about that house, but those are the main key points. And you'll probably know at the time of inspection if there's anything wrong with that house that would prevent you from being warm, safe, and dry. For example, there's a major issue with the roof. You're leaking, signs of, or you got mold, signs of water in the attic, or let's say in the basement, in the case of your foundation has cracks in it or the house is settling incorrectly. There may be big ticket things that would cause you to walk away from the home. And that's okay, you could do that. If you have a home inspection contingency, you can back out of the purchase. You'll still have spent your money from the home inspector because you're paying a licensed person for their time, but you should get your deposit money back, when the offer money, if you have a home inspection contingency. If you don't, you likely have to keep moving forward with the purchase of that property. When I bought my first home, was a townhouse. For whatever reason, the seller took out all the screens in all of the windows. And we obviously wanted the screens in. So we estimated it to be somewhere around $2,000 to replace all the screens in the house. But instead of actually requesting that they do the repairs, we just requested that they give us a $2,000 closing cost credit, and we wanted to do the work ourselves to ensure that we're putting the right screens in that we want, and that, you know, if the seller, if it's on them, they may not do, they may go with the cheapest possible, right? So we wanted to put those screens in that we wanted and use the money towards that. All right, so for the sake of this video, let's assume for a second the inspection goes well. We're gonna move on to step number 4, which is to sign the purchase and sales agreement. Now remember, in Massachusetts, we have this extra step that most states don't have. Most states do pre-approval, then they go offer with a home inspection contingency. Massachusetts builds in, and there's a couple states like this, an extra step where we go offer, inspection, purchase and sale. Okay, so just in case you're in one of those states, we're gonna talk about this step here. So this is step number 4, which is to sign the purchase and sales contract. Now, this is a stage where in Massachusetts, the attorneys get involved. And in other states, you may have title companies. And what they do is they take the 2-page offer document and they turn it into a 20-page legal contract, right? They do what attorneys do best. And they build in a lot of language to protect the buyers or their sellers. Why does this happen? Well, for the most part, attorneys are, they're relatively experienced. They've been doing it for a while. They've done a lot of transactions, and something probably came up in a prior transaction, and they said, I'm never gonna let that happen to my seller or buyer again. So they build in language into the purchase and sales contract to protect their buyer or seller. Well, over the years, they keep adding to those contracts so they can get pretty lengthy, okay? So what we're gonna do at this stage is you're gonna review the contract with your attorney or title company. Now, it's important here to note that anything that you want in or out of that house within reason, you would need to build into that contract or the sellers are not liable for it. The most common example of this is probably the appliances, okay? If you hate the appliances and you want them out, you need to be in that contract. If you love the appliances or the chandelier, let's say, and you want them to stay, it needs to be in that contract. And your attorney or title company and your realtor will help you out with this. The next thing that's gonna happen is you are likely gonna have to come up with more money. And in the case I'm using, let's say you're buying a house for $500,000. Okay, at this stage in the home buying process, you'll have to usually come up with at least 5% of the purchase price. So in my example, that's $25,000. But remember, you've already put a $1,000 deposit down. So now at this stage, you'd be writing another check for $24,000. You put them together and now you're in for your full 5%. Again, that money also sits in an escrow account or an intermediary account that will then be delivered to the seller at closing. Okay? So at this stage, you've negotiated some terms, you've sat down with your attorney, all right? You've also written another check. Once the seller signs the contract and you sign the contract as the buyer, you move on to the next stage, which is step number 5, and that is to begin the mortgage process. Now, as your lender, I'm aware that you have an offer accepted on a contract, and I'm kind of sitting on the sidelines watching all this happen. Once you have your signed purchase and sales contract, then it's my job now to go get you the money. Remember, what is your lender's actual responsibility here? What is our task? What are we doing? Well, think about it like this. We are a team. You, the buyer, and we, the lender. It's our job to put our money together to give to the seller to buy this home. In my example, your job is to come up with the $25,000. Our job is to come up with the other $475,000. We put that money together, we give $500,000 to the seller. So we are a team. So at this stage of the process, it's my job to begin getting you that money. As a loan officer, I am your liaison to that $475,000. It's my job to make sure that we deliver that money the day of closing. So what are we gonna do at stage number 5? Okay, well, a couple things. The first thing we're gonna do is we are going to discuss the terms of the loan that you are looking for. Okay, the terms of the loan could be a 30-year fixed, 20-year fixed, 15-year fixed. You may prefer an adjustable rate mortgage, and I'm gonna get into that at a later video. But an adjustable rate mortgage is simply a loan that's fixed for a shorter period of time, which typically gives you a lower interest rate. Regardless, we're gonna go over the terms of the loan. Once you have decided on which option makes the most sense for you, we're gonna lock that interest rate and then send you disclosures to sign that break down all the terms of that loan. These disclosures are typically just for compliance purposes. They are not legally binding. This is not the closing paperwork. This is just to keep the ball moving down the field and making you aware of the loan that you have agreed to. The second thing we typically do at this stage of the process is order an appraisal on the house. Appraisals will run you some money, depending on where you live, probably north of $400 for an appraisal. Okay, when we appraise a house, we're just basically making sure that it's worth what you're paying for it, that the home is there, right? How do we know? All right, until we send somebody out there. An appraiser is the lender's eyes to the property. So we're gonna make sure it's worth what you're paying for it, make sure it's there, and then make sure it's in good condition. Okay, that's really what an appraisal is gonna do. And then the last thing that we're gonna do is probably collect updated documentation from you. So think of it like this. Let's use an example. Let's say I pre-approve you in January. All right, so in January, I've collected your pay stubs, your bank statements, the things that I need to get you pre-approved. But you don't find a house and get an offer accepted until September. Well, your pay stubs and bank statements at that point are gonna be outdated, right? So what you're gonna do is we are likely gonna say, hey, let's just maybe update the credit if the credit has expired. Give me some updated pay stubs and bank statements just so we can verify that you have the money and your income hasn't really changed. And then we take all of that, the appraisal, the disclosures, and all the updated documentation, and we're gonna submit it to an underwriter to get your loan approved. And that's step number 6, underwriting approval or loan approval. Okay, now an underwriter is just the person who can approve or deny a mortgage. And if the lender, the loan officer, has done their job correctly, this probably should be the easiest part of the process. It's my job to know what you qualify for and to get you pre-approved for it. It's the underwriter's job to basically put the stamp of approval on it. Now, what will likely happen is your loan is going to get approved with conditions. This is very normal. This just means that your loan is not yet cleared to close. 1 or 2 things usually have to happen in order for the loan to be cleared to close. Let's give you an example. Let's say that we have the loan approved, meaning your income, credit, and assets have all been approved, but we don't have the appraisal back yet. Well, then the appraisal would become a condition. Okay, once the appraisal is in and that condition is cleared, then, and all the conditions are cleared, then your loan would be cleared to close. Okay, there's usually no cost at this point in the process, so that shouldn't be an issue. Once we have the loan approved and the conditions are cleared, you're cleared for closing, then we move on to step number 7, which is closing, the most exciting part of the entire process. All right, so at step number 7, closing. What do we do at a closing? Well, the first thing you're going to do is likely bring more money. I know, it's a lot. All right, now this money, I typically tell my clients you should budget somewhere between probably 1.5 to 3.5, and maybe some states more, 1.5 to 3.5% of your purchase price to the closing table. So for my example, let's split that in the middle. Let's say 2%. So we're buying a house for $500,000. You would need to be prepared to bring roughly 2% of the purchase price to the closing table. In this example, about $10,000. Now, what makes up that $10,000? Well, the first thing is you're going to have closing costs. Your closing costs are lender fees and legal fees, which is either your title company or your real estate attorney. Okay, so you have closing costs. The next is property taxes. So what happens is when you buy a home, your taxes are going to be included. There's a little piece of taxes included, 1/12 essentially of your taxes are included in the mortgage payment. So if your property taxes are $4,800, $400 a month would be included in your mortgage payment. And every time you write a check to us, we take out $400, put it into a separate account, which we will then use to pay your property taxes as they come due. But you have to give us money at closing to start that account for you. Because if you don't, the next time the property taxes are due, if we don't have any money in that account, your taxes are gonna go into arrears, and that's bad. So you're gonna give us money at the time of closing to start a tax escrow account for you. The next thing that's included in that 2%, my example, is homeowner's insurance. Same thing happens. You're typically gonna pay for the full year in advance. So let's say your homeowner's insurance is $2,400 for the year. You will typically pay your homeowner's insurance either at or right before closing for the full year. So you're covered for that year. But then we're gonna take out $200 of every mortgage payment you make to us, which is 1/12, all right, and tuck it away into an account so that every time you make a mortgage payment, you're giving us 1/12 of your insurance, or $200. And by the time your premium is due a year from your closing, we've collected 12 $200 insurance installments, and then we can go ahead and write the premium check again. So the great thing is you never have to worry about paying your taxes or your insurance, because the lender is likely going to pay them for you if you set the loan up that way. Okay, and then the fourth piece of what's included in that 2% is something called per diem interest, which obviously stands for per day interest. You don't have to be a Latin major to know that one. And what that essentially means is if you are closing with on the 25th day of a 30-day month, you don't get those 5 days for free. You would actually bring that money to the closing table. So let's say, as an example, that it costs $100 a day in interest for this loan. If there's 5 days left in the month, you would bring that $500 of interest to the closing table. But here's the cool thing. When it comes to mortgages, your first payment isn't due until the following month. So if I were to close you in September, let's say September 25th, your first payment wouldn't actually be due until November 1st. So in a way, you skip October. But what's really happening is interest is accruing every single day in October, and then you pay for all of that interest on November 1st. So again, at a closing, the first thing you're gonna do is you're going to bring a check for any remaining down payment money and your closing costs, property taxes, homeowners insurance, and per diem interest. You'll bring one check or you'll send a wire. Okay, the second thing that's gonna happen is you're going to sign all of the closing documents. Now, a lot of these documents are gonna look similar to what you signed when you signed the disclosures. Plus, there'll be some other ones as well. Okay, once you've signed out all the documentation, at the same time, your lender is going to fund the loan, which essentially means we're gonna wire our $475,000 to one of either the attorney or the title company to then disperse the funds to everyone that needs to get paid, including the seller. Okay, so once you've brought your money to the table, you've signed all the documentation, the lender has wired the funds, and those documents that you signed get recorded at the Registry of Deeds, that's when you get your keys and you are now the legal owner of that property. Pretty exciting, right? It's pretty simple, isn't it? Now here's the thing, I always tell my clients, okay, and then we're gonna get to a pro tip in a second for how to increase your chances of getting an offer accepted in a seller's market, okay? But first, here's the thing I tell my clients all the time. I just gave you a lot of information, all right? You don't need to know any of that. As long as you put the right triangle of people around you, your team, you're gonna be perfectly fine. As long as you have the right lender, realtor, an attorney or title company, it's our job to work as a team to get you through this process as smoothly and as quickly as we possibly can. As long as you do your job, right, and get us what we need when we need it, you're gonna be totally fine. Now, pro tip, okay? So one of the things that's happened recently in the mortgage industry is that because it is so competitive, there are so many buyers and such a lack of good properties, increasing buyer demand, okay, is what the mortgage industry has done is instead of doing pre-approvals, a lot of lenders, like my own lender, Guaranteed Rate, who I work for, we are doing upfront approvals, actual underwritten approvals. So we're underwriting the loan first, and then you're shopping around with an actual underwritten pre-approval versus just a standard pre-approval. So what's the difference and why does it matter? The difference is a pre-approval is really just done by the loan officer. An actual loan approval is done by an underwriter. Okay, it's essentially stronger because it's been through underwriting already. So let's use this example. Let's say that you are making an offer and you have an underwritten approval, okay, and another buyer is making an offer for the same money, let's say $500,000, but theirs is just pre-approved. If the money is the same, it is likely that you're gonna get your offer accepted with an underwritten approval because essentially there's less risk. The sellers know that you've already been through underwriting and that you're already approved. My pro tip is I highly recommend you work with a lender that will actually underwrite your loan and get you approved up front, therefore making your offer stronger and having you stand out amongst all the other buyers that are making offers on that same property. All right, so thank you so much for watching. Again, if you enjoyed this, give me a like, subscribe. I'm gonna have a lot of future content coming out. If you have any questions, please don't hesitate to reach out and I'll get all those questions answered. And I look forward to seeing you on the next video.